Hello everyone, my name is Johan and today I am going to give a presentation on my final year project. This is a joint industrial project by ASI and NTU that seeks to design AI-based trend analysis tools. To be specific, we will be looking at a subset of machine learning called hierarchical learning. Firstly, let me give a brief introduction of the project. There has been an increase in usage of AI for trading automation, if not for attaining insights of the stock markets. Many of the largest financial institutes in the world have increased their investments towards machine learning, and we have even seen a new breed of financial institutes where their core businesses are in robo-advisory or algorithmic trading. An example of such companies are Stashaway, Auto Wealth, and Renaissance Technology. There is thus an increased motivation for other institutes to get on board this trend as a consequence of the increased awareness of the benefits as well as for the fear of losing out to their competitors. The aim of our project is to utilize hierarchical learning for market index trend predictions. In this case, we are going for a three-class classification problem of whether the market is bullish, stagnant, or bearish the next day. The model will take up a swing trading approach that spans 2 days, meaning that it will analyze the market and buy at the end of the first day, and then sell it at market open the next day. We will be using Dow Jones Index for a proxy of the market conditions in this project. I will elaborate on what is hierarchical learning later on in the slides. Right now, let's quickly talk about the tools involved in this project. I'm using an Ubuntu distribution with NVIDIA CUDA enabled. The prominent libraries that I am using are FastText, Keras, Scikit-learn, and Y-Finance. It's essential that the project is performed in a Unix environment due to the requirement of FastText library. As for the project schedule, I have split the duration up into 4 main stages. First, the planning and setup stage, where preparation as well as literature review is done. Second, the development stage, where I develop 2 hierarchical models as well as the benchmark ARIMA model. Third, the re-evaluation and improvement stage, where I analyze my model's performance and make minor adjustments. Lastly, the final evaluation and documentation stage. Here is a Gantt chart to provide a more detailed illustration of what has been done. The project spanned across from August 2019 to May 2020. This Gantt chart is non-exhaustive as it serves to only illustrate the major milestones of this project. If you are interested in the details, you are welcome to pause the video right here and take a good look. I'll move on to the second segment of this presentation. I'll briefly explain the 2 important terminologies used throughout. The first terminology is hierarchical learning. Hierarchical learning seeks to break down the larger problems into smaller ones where you build policies for each sub-problems. This trend in machine learning came about in an attempt to mimic human learning. I'll give an example of how human learns in a hierarchical way. Suppose you were lost and asked me for directions to the nearest bus stop. I would likely say something along the lines of, walk straight from here and take the first right. This information is superficial and has a low information resolution. How many meters straight isn't specified, nor is the idea of how many degrees to the right you should turn. Yet it is understandable for humans because you are able to build upon previously learned information. In this instance, we have already learned how to walk straight, for example, which further invokes a lower level learning of how to move your leg muscles to walk. In the case of AI, they are able to allocate submodules of their model to focus on a certain hierarchy of information resolution. Their output is then passed on to another submodule of the higher hierarchy, which does the same thing. This is intuitively beneficial as each submodule is specialized and the data coming in is of a narrower nature. The next terminology I will go through is the ARIMA model. ARIMA stands for Autoregressive Integrated Moving Averages. This is the de facto model used in the financial industry. It was created during the pre-neural network era and is a mathematical model that performs regression on moving averages of a certain window. When we specify an ARIMA model, we have to determine 3 main values for it. First is P, the number of lagged observation. This means how many days of prices you are looking at prior to today. The second is D, which is the degree of differencing. This is used in calculating the regression line of the moving averages. Thirdly is Q, which is how much the window of moving averages shifts. For the next segment, I'll go through 3 interesting literature that I want to highlight. The first is a hierarchical neural network research performed by Lachihab et al. In this research, his team found that hierarchical networks offer better accuracy than artificial neural network, and this is attributed to its hierarchical layer's ability to reduce noise. The second literature that is of importance is performed by Zheng et al. In the space of classification problem. They found that hierarchical fast stacks produce 4 to 35% improvement over non-hierarchical sentiment analysis model. The third literature is performed by Melandri et al. Regarding asset allocation with LSTM. There were few publicly accessible research done on hierarchical models that utilize price sequence data. The reason being that hierarchical models are not widely researched yet, and it is still a novel approach, especially for the finance sector. Hence, we have to turn to the base models to understand which fundamental architectures are likely to perform better. For the case of price sequence data, the LSTM showed better time series results than the random forest classifier and the multi-layer perceptron. It is also specified that LSTM with sentiment analysis showed distinctively better returns. What this means for us is that we should focus on 2 hierarchical models, one for sentiment analysis and the other on time series data. As with all research, our research comes with some implicit assumptions. I'll highlight the 2 most consequential assumptions. The first is the efficient market hypothesis. This hypothesis is broken down to the weak, semi-strong, and strong form. What it states is that prices should reflect all known knowledge of the underlying asset. Depending on the form that it takes, the definition of all known knowledge changes, with the strong form taking on the strictest and most general approach to defining known knowledge. For our model to retrieve information from news articles and price data, we have to reject all 3 forms of efficient market hypothesis. We believe that there are information that are publicly available that isn't reflected in the current price actions. The other assumptions we rejected is the random walk model. Random walk model states that the price actions at each time step takes on a random direction and each time step is independent from one another. This means that the action of today's prices are independent of the previous day's prices. Again, we reject such a model as we believe that a sequence of prices allows us to understand the trends of the market, which in turn is able to predict the future short-term trend. Now let's talk about the data required. There are 2 forms of data used. One is a news dataset and the other is a pricing dataset. The data span from 20 October 2006 to 19 November 2013. The first form of dataset is for sentiment analysis. It comes in the form of news articles from a financial news agency. And here's a sample. We perform pre-processing on this data by removing punctuations, normalizing all the letters, manually removing typos and errors, and removing stop words. We also place a limitation that an article should be more than 100 characters to be considered for training. Subsequently, the articles went through stemming. This pre-processing took a bulk of the project timeline due to the tediousness of cleaning the data. For example, some articles were of ads that were incorrectly retrieved when crawled. This was removed by manually reading the articles and deleting them. We performed a preliminary checks on the sentiments, and we found that the majority has a positive sentiment. This is expected as for this period, the majority of the time is a bullish market. The second dataset is for adjusted returns, which was calculated from the adjusted daily closing price of Dow Jones Index. As you can see, there was a bearish market in 2008 due to the financial crisis and subsequently a bullish market. This supports our finding previously that the majority of sentiments are positive. To develop unbiased models, we perform stratified sampling to create an equal weightage of bullish, stagnant, and bearish trading data. Pre-processing models such as standardizing the date format was done along with some other pre-processing specific to the LSTM requirements, but I will not go into detail on this for this presentation. I have also tried performing Fourier transform to smooth the time sequence data, but this proves to introduce more noise and reduce performance. The way we categorize the next day returns are as such. If it is less than -1% the next day, it is taken as bearish. If it's more than 1% the next day, it is taken as bullish. Everything else will be considered stagnant. The reason we came to this threshold of 1% was due to empirical research from literature review. was shown that on average, the two-way transaction fees of a trade amounted to 1% of the principal. Hence, it will only make sense in most cases to do a trade if the returns were more than that of the transaction. For the case of stagnant label, the institutes will have to utilize a pair of options to profit from the flat price movement. The first hierarchical model I have designed is the Hierarchical Natural Language Processing Model. I will call this model HNLP. To create the model, we used Facebook's FastText, which encompasses a hierarchical neural network for sentiment analysis. FastText is an open source library written in C++ that was developed by Facebook Artificial Intelligence Research Lab. This architecture is said to be scalable and lightweight for text classification causes. The reason we chose FastText as the hierarchical architecture for sentiment analysis has much to do with literature review. It was found in separate researches that FastText has comparable, if not better performance than most architectures out there. This picture showed the results of Jolin et al. We see that one epoch takes seconds to train while it took minutes, if not hours, for deep learning. And in this picture of Bojanowski et al., we see that FastText performed better than CNN across different datasets with comparable, if not better, accuracy. So we deduce here that FastText is a promising hierarchical model which we can utilize in the field of finance. We specify a hidden layer of 1 and utilize hierarchical softmax layer to output either a bullish, stagnant, or bearish data. The hierarchical softmax layer can be performed in O log n time, which contributes to the scalability and low training time of the architecture. This is done through half-man encoding, which creates a hierarchy of classes with only log n storage. The imbalance of output classes in practical situation of swing trading further leverages on the strength of a hierarchical tree. The pre-processed news article data is then tokenized and fed into the model. At a high level, FastText was designed as a hierarchical neural network that utilizes a mix of bag of words, bag of n-grams, and word-to-vec. This mix provides a better chance of estimating out of vocabulary words. I'm sure you know what bag of words is, so I want to talk more about bag of n-grams. For example, a word where will be split into a bag of trigrams as such. So with bag of n-grams, even if the out of vocabulary words do not share the same n-grams of words, the word may still have a character n-gram that the model has seen before. That's why it is easier to estimate out of vocabulary words by using a mix of bag of words and bag of n-grams. For training, we are using the holdout method to evaluate our model. 70% of the stratified dataset will be used for training and subsequently tested on the remaining 30%, which search was subsequently employed to fine-tune the hyperparameters of the hierarchical FastText model. We settled on learning rate of 0.001, 5000 epochs, a hierarchical softmax loss, and the choice of using n-grams of 3. F1 score is used to evaluate the performance of the model. The second hierarchical model that was developed was a hierarchical long short-term memory model. At its core, the hierarchical LSTM utilized a vanilla LSTM cell. It was then provided with a time series hierarchical architecture. This means that the submodule will look at different windows. For example, the highest hierarchy may look at the entirety of 5 days, the second hierarchy may look at it from 3 days, and so on. The hierarchical LSTM was designed with the help of the Keras library. Again, the rationale here for using a hierarchical RNN is due to literature review. Zhao et al. Showed that hierarchical RNNs outperform their non-hierarchical counterparts. This can be seen in the last 2 rows of the table, where hierarchical RNN shows a better performance across accuracy, F1 score, precision, and recall. Coupled with our knowledge that RNN tends to be the best when it comes to time series data, and LSTM performs better than most other forms of RNNs, we opted to try out a hierarchical LSTM structure. As mentioned 2 slides ago, the hierarchy is achieved through temporal distribution. Briefly, I would like to talk about the internals of an LSTM cell. Input in the form of xt is passed through multiple pointwise functions, and there are gates which decides to combine it with the cell state ct-1 and the hidden activations ht-1. These states are then passed on to the next LSTM cell. One of the perks of using an LSTM for time series data is that it solves the vanishing and exploding gradient problem. Hence, we can be sure that the weights will not get too large or too small in training. In designing the hierarchy, we created layers as such. The top layer, which looks at the largest window, has only bottom-up and recurrent connections, meaning that it fits on the output of submodules in the lower and similar hierarchy. The middle layer have all connections in the form of bottom-up, recurrent, and top-down, while the bottom layer can only fit its output upwards and for itself. Here, we are also using the holdout method to validate our training. This is a 70-30 train test split of the data. By trying out different time periods, we found that the window of 5 days is optimal. This means that the model looks at the returns of up to 5 days before. We then performed grid search to conclude with a batch size of 500, 5 hinder rows, and 1,500 epochs. The way we will evaluate the model results is with 3 methods: F1 score, consistency, and trading time. The F1 score is a metric that ranges from 0 to 1 and was chosen because it takes into equal weightage of precision and recall. While we wanted the model to be more accurate, we also wanted to minimize how often we are likely to be given a false negative. Precision of our model can be said to account for the proportion of retrieved price trend results among all the relevant price trend results in the test dataset. On the other hand, the recall of our model is the proportion of relevant price trends results among the total retrieved price trends results. When we pit our hierarchical model against the de facto RMR model across 5 independent tests, the results are as such. HLSTM attained the highest F1 score of 0.526. Overall, HNLP and HLSTM achieved the highest mean F1 score, which was roughly twice that of the RMR model. While the RMR model showed the most consistency, we deemed that all 3 models' standard deviation fell within our predefined limits of plus-minus 10%. When it comes to training time, the RMR model performed the best with a training time of only 1 minute. LHLSTM came a little behind with a training time of 15 minutes, and the HNLP took roughly an hour. While we do see a staggering difference in terms of training time, it should be noted that HNLP and HLSTM takes roughly the same time to train one epoch. However, due to the nature of the dataset, sentiment analysis tends to take a little more epochs to train. Nonetheless, in the context of swing trading across 2 days, all 3 of them provided enough buffer for the analysis to be done for analysts to verify the classification, perform due diligence, and execute the trade. Thus, we deemed all 3 models to be satisfactory on the metric of training time. Of course, some future works are in order. For a start, we are intending to publish our paper titled Hierarchical Learning for Market Index Trend Predictions to IEEE Journal. Since there are little research done on hierarchical models in the field of finance, we hope to do our part by contributing. Some suggestions for future works include using a training data that mimics the weightage of the index. For example, the Dow Jones Index has a higher weightage of technology industry and healthcare industry. When we used a equal weightage training data, it does not learn that a negative sentiment on the technology industry is likely to cause a drop in the market returns, even with a positive healthcare news. Next, instead of using training data that spans across both bullish and bearish market, it might make more sense to specialize only on one so that the model can learn the weights of the market environment. Lastly, as mentioned by Melandri et al. In our literature review segment, we may see higher performance if we use an ensemble of sentiment analysis and time series analysis. In conclusion, we are seeing a higher overall performance with hierarchical methods compared to the industrial standard ARIMA model. Specifically, we found that the hierarchical LSTM is the most promising as it was able to reach the highest performance among the 3. Hence, this research gives justification that more financial institutes should move away from ARIMA model and utilize hierarchical models instead. Before I end this presentation, I would like to thank Dr. Wong from A*STAR and Dr. Li Fang from NTU for their guidance in the past year. Their contributions have shaped this research. That's all for my presentation. Thank you. If there are any questions, you are welcome to email me at this address.